it's Matt Decker with Leveraged Wealth Management. I'm so excited for you to join me here today because we're going to be talking about one of my favorite topics, and that is indexed universal life expenses. Now, there are all kinds of misconceptions surrounding indexed universal life, specifically when it comes to the fees and the expenses inside the policy. And there are some challenges when diving into this topic because since it's an indexed universal life contract, universal being the key word, the premiums that you pay are flexible. The death benefits are also flexible. So it can be really difficult to pin down the actual expenses in an indexed universal life contract because most of the expenses are going to depend on how the policy was initially structured. So all I want to do in this video is really focus on two areas of expenses as it relates to indexed universal life. Number one, I hear all the time that the expenses in IUL are just simply too high. So that's the first thing that we're going to talk about. The second thing that we're going to talk about is a common misconception, and it's often a half-truth told by people that know nothing about indexed universal life, and that is that the fees go up every year. Okay, common misconception. I would consider this a half-truth, and that's something that we're going to talk about today. But the way that we're going to go through this is with a really cool tool that puts the fees inside indexed universal life insurance into perspective. It makes everything easy to conceptualize, and it kind of lays things out in linear format without you having to look at a giant table with a bunch of numbers on there, and just makes it really nice. So what we're looking at here is just a sample illustration that I put together earlier today. It's for a 45-year-old male, and this is using the Allianz Life Pro Plus Elite product. It doesn't really matter what product we're using as long as we're staying away from, some of the really terrible ones out there as far as fees are concerned that I've talked about in past videos on my channel. If you want to look at some of those, I will link those on some call out cards above. I did a video on Lincoln. I also did several videos on Pac Life and the expenses in those two companies just being absolutely outrageous. Those are outliers. This is going to apply to all the other policies and all the other products out there that are not outliers, like the Pac Life and the Lincoln and maybe one or two others. But here's what I want to focus on when it comes to fees. It's really important that we understand how these products are priced. So I want you to focus in on the chart down here below. And what you'll notice, and I say this all the time, these products are front-loaded with fees. That's how they work. The majority of the fees come in the first 5 to 12 years. And you can see that right here on this chart. From age 46 to 55, that's where you're paying the bulk of the fees. That's where the insurance company is making a little bit of profit for themselves so that they can service these contracts for life. The bulk of the fees in these products come when your account values are the lowest, okay? And that's important because what makes these so powerful is that the fees that you pay actually get lower as you have more money in the contract. So let's just break this down. I want to show you exactly what we're talking about. So we're looking at fees compared to the cash in the policy and the income that has been taken out of this policy. So there's some income coming out of this policy, and that's what we're looking at. And you'll notice that once you get 10 years into the policy, your total fee as a percentage of the cash in the policy plus your income is 1.65%, okay? So that's actually, average for a money manager. You'll notice that it's much higher at age 50, 49. You have less money in the contract, and so your fee as a percentage of the money in the contract and your income, which at this point there has been no income, is higher. That's fairly straightforward. As you get more money in the contract, the fee starts to drop. Now, what's really cool is once we get past, 12 to 13 years, watch what happens to our fee. If we just go from age 55, where we're paying 1.41% in fees as a percentage of our total cash and our total income, what happens if we just go out 5 more years to age 60? It drops to 75 basis points. 5 more years at age 65, 45 basis points. Age 70, 29 basis points. age 75, 22 basis points, age 80, 18 basis points. And I hear it all the time. These policies are going to blow up in your late 80s and early 90s because the fees are outrageous. Are they outrageous? Because at age 90, the fees as a percentage of your cash surrender value and income are 21 basis points. At age 95, the fees are 24 basis points. Now, let me explain what that means. That means the fees that you're paying are 1/4 of 1%. 1/4 of 1% at age 95, when every single person out there who's selling whole life that knows nothing about indexed universal life says that your fees are going to blow up this contract. How can your fees blow up this contract at 95 if they're 1/4 of 1%? It's just not going to happen. It's just not the way that these policies are designed. 1/4 of 1%. What does 1/4 of percent compare to when we're talking about what else is available out there in the marketplace? Well, if you want to get a no-load mutual fund that mirrors the S&P, you might find one that has an expense ratio around 1/4 of 1%. I mean, that's what we're talking about. This is one of the lowest fee vehicles that exists in the marketplace once you get past those first 10 to 12 years where the charges are front-loaded. That is how these policies work. I'm unapologetic about that because by paying the fees up front, you have a contract that's now going to grow tax deferred. It's not going to be subject to market risk. As you have more money in the contract, you pay less in fees overall, and all the money that comes out of this policy is income tax free. And when you pass away, there's a death benefit that goes to your beneficiaries, income tax free, and all of that is done without market risk. Now, there's something else that's important about this discussion. I told you that life insurance is too expensive. We hear that all the time. Life insurance is too expensive. Well, based on what I'm looking at here, the life insurance is not too expensive. Keep in mind, you're paying a huge percent in fees in the first several years. Well, why is that? Well, because this policy has a pretty large death benefit. It's about $1 million death benefit. If you die inside the first 10 years, the company's on the hook for $1 million. So yeah, there are some fees associated with that. But long term, the fees on this policy are actually a major benefit to this contract. The other thing that we talked about was that fees get higher as you get older, and the total dollar amount in fees may get higher as you get older. But when you compare the fees to what you actually have in cash and what you're taking in the form of an income, that's actually the exact opposite. It gets cheaper as you get older, cheaper as you get older. Imagine that. All these years, people have been saying these policies are going to blow up because the fees get higher as you get older. Well, guess what? That phenomenon exists in just about every other account that's available. If you have money with a money manager at 1%, guess what? When you have more money, you pay more money in fees. So as you get older, if your money's growing, you're paying more in fees. Is that a negative? No, that's just kind of how it works. In this policy, the amount of fees that you pay compared to the cash in the policy actually gets lower and lower over time. Now, there's one more thing I want to say before we wrap up this video. This policy has been structured the right way, meaning this is a minimum commission, maximum cash, maximum income policy design. If I had went into this policy software and ran this policy in order to maximize my own commission, in order to put myself first before the client and try to make as much money as I possibly could, the fees in this contract could double or triple. And now all of a sudden, maybe this isn't such a good vehicle because I've structured it for maximum commission, not maximum cash, not maximum income. So just because what I'm showing you here looks phenomenal, looks amazing, it doesn't mean that your policy is going to look phenomenal or look amazing. I already talked about two outlier companies at the beginning of this video, Pac Life and Lincoln. Their fees are outrageous. You'd never see an 18 basis point fee compared to net surrender value and cumulative income at age 80 in those products. It'd be much, much, much higher. It might be 7 or 8% right here. Okay, so that's outrageous, and that's not what I'm talking about. And you might have a policy that's been structured poorly. that's been structured in order to generate maximum commissions for the agent who sold it to you. And if that's the case, your fee structure is not going to look like this either. So here's what you need to do. If you have an indexed universal life insurance policy and you don't know what you're paying in fees, you need to go to my website. You need to go to leveragedwm.com/IUL-review. leveragedwm.com/IUL-review. When you get there, it's going to look like this. leveragedwm.com/IUL-review. You're going to take a really quick quiz. It's going to ask you if you have a current policy or if you don't have a current policy. If you have a current policy, it's going to ask you how much you're paying, what the purpose of the policy is. And ultimately, it's going to give you an opportunity to send me your policy so that I can do a personal review for you and make sure that what you have is actually going to accomplish your goals and do what you want it to do. So leveragedwm.com/IUL-review, or you can click the link above and it'll take you right to that website. You fill out this real quick quiz. It's 4 or 5 questions. Yes, I own a policy, or no, I don't. I want to generate maximum income. Yeah, I'm contributing over $400 a month. Okay, you qualify for a review. There's a quick video that you can watch with instructions. You fill out the form. It's going to send you an email so that you know what I need from you. That's the only purpose for that sign up. It's so that you can get that initial email with some starting instructions on the information that I'll need in order to start your review. I got some testimonials down below that you can check out. But if you have not had your indexed universal life insurance policy reviewed, if you are currently in the process of purchasing an indexed universal life insurance policy and you don't know what you're paying in fees, you need to go through this process. It can be the difference between an extra 20, 30, 40, 50% in retirement income just by making sure that your policy is structured the right way. I look forward to talking with you soon. If you haven't done so already, subscribe to my channel, like this video, share it with your friends, and comment down below. Let me know what topics you want me to tackle next, which other policies you want me to review. Thanks so much for taking the time, and I look forward to talking with you and doing your IUL policy review. Take care.